What if I told you that investing isn't just about buying stocks or real estate, but about making your money work for you over time? In a world where everyone's looking for quick financial fixes, there's a much smarter way to build wealth, and it all starts with understanding the power of investing. Whether it's stocks, bonds, or even investing in yourself, the truth is it's an investment, bro. Today, we're diving deep into why investing is one of the most important things you can do to secure your financial future. So before we get started, make sure to hit that like button and subscribe to my channel for more tips and insights. 1. Long-term gains over short-term results. Investing is fundamentally about thinking long-term. It's easy to get caught up in the excitement of quick returns or fast gains, but the true value of investing comes from patience. When you put money into assets like stocks, bonds, or real estate, you're not necessarily expecting to see huge returns right away. In fact, most successful investors have held onto their investments for years, sometimes decades. These long-term investments allow for growth that can weather short-term volatility and ultimately provide greater wealth accumulation over time. Relying on short-term profits can lead to impulsive decisions and a higher risk of losing money. 2. Money makes money. One of the most powerful concepts in investing is that your money can work for you. When you invest, you're not just putting your money somewhere and hoping for it to stay there. Whether you're investing in stocks that pay dividends, purchasing bonds that yield interest, or putting money into real estate that appreciates over time, you're generating income from the money you've already invested. The concept is that money, when placed in the right assets, creates its own cycle of growth. Over time, this can result in substantial returns without you actively working for it, which is the foundation of wealth building. 3. Risk and reward. Every investment involves some level of risk, and understanding this risk is critical to becoming a successful investor. The basic rule is that the higher the potential reward, the higher the risk involved. Risk can come in many forms, such as market volatility, economic shifts, or even company-specific risks. For instance, stocks in emerging markets can yield incredible returns, but come with the risk of fluctuating prices. Conversely, low-risk investments like bonds offer more stability but with lower returns. Understanding your own risk tolerance is key to building a diversified investment portfolio that balances risk with the potential for rewards that align with your financial goals. 4. Diversification is key. One of the most important strategies for managing risk and investing is diversification. Diversifying means spreading your investments across different asset classes, sectors, and geographical locations. The idea is that not all investments will perform poorly at the same time, so having a diverse portfolio reduces the risk of a complete loss. For example, if you invest only in one company or industry, you risk a total loss if that company or industry faces trouble. But by diversifying, you're ensuring that if one area of your investments underperforms, the others might pick up the slack and keep your overall returns stable. 5. Compound interest. Compound interest is often called the eighth wonder of the world because of how powerful it is in growing wealth. When you earn interest on an investment, you don't just earn interest on your initial investment, you also earn interest on the interest itself. This interest on interest creates a snowball effect, where the longer your money stays invested, the faster it grows. For example, if you invest $1,000 and earn 10% interest annually, you don't just earn $100 in the first year. In the second year, you'll earn interest on $1,100 and so on. This compounded growth allows your investments to grow exponentially over time. 6. Investing in yourself. While financial investments are crucial, one of the best investments you can make is in yourself. This includes investing in your education, skills, and health. Learning new skills or improving existing ones can increase your earning potential, open doors to better job opportunities, and make you more marketable in the workforce. The more you invest in yourself, the greater your capacity for growth, whether in your personal life, career, or business ventures. Additionally, investing in your health through exercise, proper nutrition, and mental wellness ensures you have the energy and vitality to pursue your goals. Self-investment doesn't always require money upfront. It can involve dedicating time and effort to personal development. Whether it's taking online courses, attending workshops, or reading books, you're equipping yourself with tools to improve your life. Health and wellness are just as important as physical and mental well-being contribute directly to your ability to work and achieve your goals. By investing in your personal growth, you're not only improving your current situation, but also building a foundation for long-term success and happiness. 7. Economic trends influence investments. Economic trends and changes in the market significantly affect the performance of your investments. Keeping an eye on factors like inflation rates, interest rates, employment data, and technological advancements can help you understand which investments are likely to thrive. For instance, when inflation is high, certain investments like gold or real estate might perform better because they tend to hold value better than cash. Similarly, understanding where the economy is heading can help you make decisions about which industries or sectors are likely to grow. Savvy investors pay attention to these trends and use them to make informed decisions about where to allocate their funds. The global economy is interconnected, and shifts in one country or industry can have far-reaching impacts. For example, the rise of renewable energy technologies has created growth opportunities for investors in that sector, while traditional energy industries have faced challenges. By understanding these economic shifts, you can predict which areas of the market are likely to boom or bust. It's not just about reacting to trends. Successful investors anticipate them and position themselves to benefit from the changes before they fully materialize. 8. Real estate as a solid investment. Real estate has always been considered one of the safest investment options. Unlike stocks or bonds, real estate provides a tangible asset that can generate rental income and appreciate in value over time. Whether you're buying a home, a commercial property, or land, real estate tends to be a long-term investment that can offer a steady stream of passive income. Over the years, property values typically rise, meaning you can sell the property for a profit later on. Additionally, real estate investments offer tax benefits such as deductions for mortgage interest, property taxes, and depreciation, which make them even more attractive to investors. However, like all investments, real estate comes with its own risks, such as fluctuating market conditions or the cost of maintenance. But with careful research and planning, real estate can be a very rewarding investment. Many investors choose to buy rental properties, earning income from tenants while the value of the property appreciates. Real estate offers multiple paths to wealth through appreciation, rental income, and tax benefits, making it one of the most reliable investment choices. 9. Investing in the stock market. The stock market has long been a key avenue for growing wealth. By purchasing stocks, you're essentially buying ownership in companies, and as those companies grow and become more profitable, so does the value of your shares. Stocks tend to have higher potential returns than other forms of investments, but they also carry higher risk. The value of stocks can fluctuate daily due to factors like company performance, market sentiment, and global events. However, over the long term, the stock market tends to increase in value, making it one of the best places to invest if you're looking to build wealth. Stock market investing can be done in various ways, such as buying individual stocks or using exchange-traded funds, ETFs, to spread risk. Successful stock market investors understand that volatility is part of the game and that short-term fluctuations don't necessarily reflect the long-term potential of their investments. By doing thorough research, diversifying your portfolio, and staying patient, you can take advantage of the opportunities the stock market provides to build wealth over time. 10. Patience pays off. Patience is often cited as the most important quality of successful investors. Wealth is rarely built overnight, and the most successful investors know this. They understand that market fluctuations, economic downturns, and short-term losses are part of the investing process. Instead of panicking during rough patches, the patient investor stays the course and allows time to work in their favor. By sticking with investments through both good and bad times, they allow their money to grow and compound. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.